I only invest in businesses I understand. And I have no idea what NVIDIA is worth. I have no idea what Bitcoin is worth. I have no idea what MicroStrategy is worth. So I don't know how far they can fall. I don't know how high they could go. I pay attention to businesses I understand, which are conventional financial services businesses and natural resource businesses. And despite the fact that I've been fairly lucky in life and I have a decent net worth and I'm 72 years of age, for whatever reason, I'd like to become wealthier. And the consequence of that is that I look at declining markets as wonderful ways to increase my wealth. If I'm looking to buy financial assets because I think over time I'm allocating my capital wisely, I'd like to see them lower, not higher. So for me, I'm not in protection mode. I'm in a fairly aggressive mode. I realize that other people require, price action to give them psychological affirmation. I don't require that at all. There's so many things that are cheap. The community bank stock business in the U.S. is insanely cheap. You need to sort through the flotsam and jetsam to find community banks that don't have portfolios overloaded with commercial mortgages and to find portfolios that don't have time spreads. In other words, you have to find banks that haven't lent long, funded by overnight funds. But there are some superbly attractive community banks in the United States with good franchises trading at 6 or 7 times income. And banking is a very good business, so that attracts me. The property and casualty sector in the United States, specialty property and casualty insurers in the United States, is a very good business. And by the way, for Canadians, take a look at Fairfax, a serially successful insurer. And my other area of expertise, which is to say extractive industries, is looking attractive. The Canadian oil and gas sector will survive Trump. It survived Trudeau, which was a much greater threat to Canada than Trump. And the mining stocks in particular, I think the gold stocks are at least reasonably priced, which they seldom are. All of that is attractive to me. If you come down to the junior space, we really are tracking that famous old movie, The Good, the Bad, and the Ugly. The high-quality juniors, the Snowlines of the world as an example, the Origin royalties, are doing extremely well. They're on a tear. The industry describes itself as being underfunded because most of the industry, at least 80% of the listings out there, are valueless. From a stock picker's point of view, the junior market probably can't get any better than this. Attractive entry points, high quality people doing very good work, and the high quality people are being funded. I mean, this is a wonderful set of circumstances as far as I'm concerned. I think the economy does weaken. And I think for a well-run community bank, that doesn't matter much. They are going to be competing with banks whose balance sheets are going to be decimated in the commercial real estate market. You can compete well in a lending market if you have money to lend and your competitors don't. I remember the survival of the fittest era in 2008, 2009, 2010, where well-capitalized banks, the Farmers and Merchants Bank of Long Beach, the First National Bank of Alaska, the First National Bank of Nebraska, little tiny banks like the Bank of Hemet, well-capitalized banks made absolute fortunes because the often bigger banks they were competing with were unable to lend. We're coming into that circumstance again. We're coming into a circumstance where commercial real estate mortgage obligations on banks' balance sheets are going to be very challenged. I think we're coming to the end of the extend and pretend era. And I think the durable competitive advantage around well-run, solvent community banks with good portfolios, I think they're in for 2 or 3 years of extremely smooth sailing. And they're priced like they're going to go out of business. This is not for somebody who doesn't understand how to analyze a bank balance sheet. This is not for somebody who doesn't know how to find out the concentration of commercial loans on a balance sheet. This is not for somebody who doesn't understand time duration. For a guy like me who's been investing in banks for 50 years, this is as good as it gets. What you have in the American economy is a whole bunch of economies, not just one economy. And the underlying strength in the American economy, once you get away from government, once you get away from subsidized industry, once you get away from the madness of overpriced service industries, is really pretty robust. Certainly good enough to make fortunes for high quality commercial bankers. Gold does well during periods of time when people are concerned about the maintenance of their purchasing power in fiat denominated conventional savings products. And I think those fears are very, very, very well placed. We've done the math before around reasons why people might be concerned about the maintenance of their purchasing power in US dollar denominated savings products. The first is truly ugly, which is to say $36 trillion in on-balance sheet obligations of the US government, or $29 trillion net of the Fed's own balance sheet. From there, we get worse, $100 trillion, which is the net present value of off-balance sheet obligations of the US government, things like Social Security, Medicare, Medicaid, military pensions, federal government pensions, things like that. The net present value of those obligations exceeds $100 trillion. You combine those two numbers, and the net obligations of the US government exceed $130 trillion. The IRS estimates that the private net worth of American citizens, which is to say the wealth that gets taxed to meet those obligations, is only $141 trillion. Now, yes, the obligations pay over time, but remember, this is a net present value number. Meanwhile, the U.S. Treasury, which is to say the obligated party under those obligations, takes in about $5 trillion a year gross before they spend any money, and Congress spends $7 trillion, which is to say, rather than servicing the debt, we increase it by $2 trillion a year on balance sheet, and another $2 trillion a year off balance sheet. The U.S. Treasury, the 10-year Treasury, the world's premier savings instrument, yields, 4.5% today? And if you believe the government's numbers around inflation, you assume that the deterioration of the purchasing power of the US dollar is only 2.6% a year. If that's true, you're making 1.9% on your savings. I don't believe it's true. I don't believe that the CPI measures the deterioration of the purchasing power of my savings. When I look at the basket of goods and services that I buy, and I look at the prices of those goods and services in the period 2020 to 2025, I believe that the real deterioration of the purchasing power of the US dollar is between 7.5% and 8%. If that's true, if the government pays me 4.5% in a currency where the purchasing power is declining by 7.5%, that means I'm losing 3% a year. And I'm losing 3% a year lending money to a counterparty that's already $130 trillion upside down. No thank you. I think the deterioration of the purchasing power of the US dollar continues because I think the only way that we fund the nominal obligations of $130 trillion is to further reduce the purchasing power of the US dollar. We did it in the decade of the 1970s. According to the Office of Management and Budget, the US dollar lost 75% of its purchasing power in 10 years between 1970 and 1980. Not coincidentally, the gold price went up 30-fold during that period of time. I'm not saying that the gold price is going to go up 30-fold this time, but you asked me how I felt about the gold price. And all of that arithmetic tells me that, well, maybe not immediately, over the next 2 years, 3 years, 5 years, and 10 years, I think gold isn't merely going higher, but likely going much higher, at least nominally, because I see the dollar going lower. I can't do the arithmetic around the fundamentals of silver because despite trying for 50 years, I don't understand them very well, nor, by the way, does anybody else. What I know about silver is that in a precious metals bull market, once gold has established the narrative, once the move in gold has attracted the generalist investor into the precious metals space, that generalist investor generally comes down market to silver pretty quickly. And when that happens, the escalation in the silver price outpaces the escalation in the gold price. I don't know that we're at that place yet. My suspicion is that in the near term, the precious metals market is still a gold-centric rather than a silver-centric market. But believe me, Jimmy, you've been around long enough to know when silver starts to move, you aren't going to have to ask me about it. It's going to be very obvious to everybody. When silver moves, it moves further and faster than gold. And of course, the best performing asset in the class are those very, very, very few high quality silver stocks. My friend Doug Casey describes the silver stock bull market as the equivalent of trying to siphon the contents of Hoover Dam through a garden hose when the generalist investor comes into a space where the market cap literally isn't big enough to contain them. Since I have no idea when or if that goal is going to be achieved, I don't care very much about it. I don't think very much about it. I remember a decently successful investor over time, a guy from Omaha. I think his name was Buffett. Yeah, Warren Buffett once said that all of the factors to consider when you're looking at a market are so broad that trying to do market forecasting is trying to know the unknowable. He suggested that you could spend 15 to 30 minutes a year trying to do market forecasting if it amused you. But an allocation of time that was greater than that was absolutely, completely a waste of time. What I know is in my lifetime, when precious metals markets have attracted generalist investors, some point in time in the middle of the market, leadership changed from gold to silver, and gold and silver performed spectacularly well. Given that I don't know when that's going to occur, I content myself with owning a position in silver stocks and being patient with them. Years can go by and those silver stocks don't pay me rent. But when they pay me rent, the rent that they pay me is truly, truly, truly spectacular. And I don't sweat it much in terms of months or years. I remember, Jimmy, when I came into the business in the 1970s, price of Coeur d'Alene mines went from 10 cents to $65. Now, sadly, I was too young and poor to take advantage of that. But in the nice market we had in the early part of the 90s, and in particular in the market we had 2000 to 2010, the silver stocks did stupidly well. I did participate in the Silver Standard 72-cent financing and watched that stock in 6 years go to $45. I participated in the Pan American Silver private placement at 50 cents and watched that stock do it at $45. And it didn't do it over my lifetime. It did it over 6 or 7 years. The move from sub $1 to plus $40 in 6 or 7 years makes somebody who is experienced extremely patient in their quest to do it again.